The S&P-ASX 200 fell 0.48% on Tuesday, but the index level understates what actually happened to positioning across the market. Fresh U.S. military strikes on missile sites in southern Iran, officially framed as self-defense operations near the Strait of Hormuz, arrived just as traders had begun rotating back into risk assets on the expectation that a deal was imminent. Brent crude had slipped below US $95 a barrel overnight on optimism around Doha talks. It bounced 2.2% within hours of the strike reports. The speed of that reversal forced institutional holders who had used Monday's oil drop to lighten hedges back into defensive positioning by mid-morning Sydney time. Property was the hardest hit sector, losing more than 2% intraday, with Goodman Group falling 3% despite reaffirming 9% earnings growth and confirming that 73% of its development pipeline now sits in data centers. The gap between Goodman's operational update and its share price reaction is the clearest signal that selling pressure came from sector rotation, specifically from foreign holders reducing ASX property exposure, rather than from any deterioration in Goodman's own fundamentals. Utilities fell nearly 2%, led by energy stocks as traders repriced the duration of the oil disruption upward. Airlines had briefly recovered last week as WTI dropped toward US $91 per barrel. Qantas and Virgin Australia shares gained 7.8% and 7.7% respectively in the 5 days to Monday. Both gave back ground Tuesday, interpreted from price action alone, as the strike news reversed the fuel cost improvement that had underpinned the rotation. With Australia importing more than 90% of its refined fuel, each dollar move in Brent crude is not an abstract macro variable for these carriers, it is a direct operating cost adjustment. The airline recovery trade had positioned on the assumption that Hormuz reopens. Tuesday's strikes made that timeline uncertain again. What the oil move does not yet fully explain is where the selling pressure transmits next inside the domestic market, because property and airlines are not where the structural repricing is being set up. The property and airline selling on Tuesday was fast and visible. The bank sector move is slower and structurally more consequential. Commonwealth Bank fell 1%, National Australia Bank fell 1.9%, ANZ dropped 1.1%, and Westpac gave up 1.1%. Those numbers sound moderate. Morgan Stanley's note, published this week, argues they may only be the beginning, citing potential FY27 earnings downgrades of around 5% for the major ASX 200 banks on mortgage margin compression and capital gains tax changes proposed in the budget. The mechanism runs directly through the same oil shock frame. The RBA has already raised rates 3 times this year. Consumer confidence sits near pandemic lows. The Australian Bureau of Statistics reported that 72% of businesses are under pressure from higher fuel costs. Unemployment ticked up to 4.5% in April, the first concrete jobs market signal of weakness. Each of these data points individually would support the case for an eventual RBA pivot. Taken together under persistent oil price pressure, they instead describe an economy where the RBA cannot cut because inflation has not resolved, and cannot be indifferent to growth because the jobs data is turning. That is the compression trade Morgan Stanley is mapping. Bank shares are priced at 18 to 19 times earnings, at the top of their historical range, precisely because the market had assumed rate cuts were coming. CBA is an outlier at 26.7 times. Commonwealth Bank made $2.7 billion in cash profit last quarter, but also increased bad debt provisions by $200 million, which it attributed explicitly to higher geopolitical and economic risk. The $200 million provision increase is the upstream position pressure signal. The bank's own credit desk is not pricing a benign scenario. Institutional holders who had accumulated bank shares on rate cut expectations now face a scenario where the catalyst for that trade, lower rates, is pushed further out by an oil shock the bank's own risk management is already pricing. The net flow picture from Tuesday's price action, interpreted from volume patterns, shows institutional selling concentrated in the Big Four rather than broad retail exit. That matters because institutional exits on rate-sensitive high-multiple stocks tend to persist across sessions once the position pressure framework shifts. The trigger is not a single strike event. The trigger is whether Hormuz reopens quickly enough to let oil fall back through the threshold where the RBA's inflation calculations change. Santos rose 1% on Tuesday, the only major energy company to gain ground while the sector broadly declined. And that divergence points directly to what makes the bank and property selling mechanically different from what happens next in energy. At its investor briefing day in Sydney, Santos presented a break-even oil price of $45 to $50 per barrel for its free cash flow generation. With Brent at $97 per barrel Tuesday, the company is generating substantial surplus cash against its own cost structure. The operational detail behind that number matters for how capital reallocates inside the energy sector. Barossa, the offshore LNG project, is running at 75% of planned 2026 production rates, targeting plateau in mid-2026 at unit production costs below $7 per barrel of oil equivalent. Pikka Phase 1 in Alaska is entering continuous production with plateau of around 80,000 barrels per day targeted in the third quarter of 2026. By simultaneously cutting $300 million in cumulative Cooper Basin capex from 2027 to 2030, Santos is concentrating capital in assets with the widest margin-to-cost gap, and doing so at precisely the moment when oil price uncertainty makes capital efficiency the decisive variable. The capital flow implication is conditional. Domestic institutional holders who sold property and lightened bank positions on Tuesday do not automatically rotate into Santos. The stock gained only 1% against a falling market, suggesting the energy move was selective rather than broad. What Santos's briefing establishes is a break-even floor at $45 to $50 that the current oil price sits nearly $50 above. If Brent remains above $90, Santos generates the cash flows that justify its current valuation without needing the war to end quickly. If Hormuz reopens and oil drops towards $75, Santos's production cost advantage narrows but does not collapse because the break-even is structurally lower than the range where most bearish oil scenarios land. The residual question, the one that connects all three domestic assets damaged by this oil shock cycle, is whether the RBA's next move comes before or after Santos's Pikka production reaches plateau in Q3 2026. If the jobs data continues to soften while inflation stays elevated, the RBA holds. That holding condition is simultaneously what depresses bank multiples, keeps Goodman's valuation under pressure, and maintains the oil price environment in which Santos's free cash flow advantage is most visible. Watch the May unemployment print due in June, alongside the Hormuz negotiation timeline. If unemployment rises again while Brent stays above $90, the shared capital frame that drove Tuesday's selling has not resolved. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.